You're listening to Kitchen Table Finance. Join Dave Shotwell and Nick Nauta as they cut through the complexity of financial planning and serve bites of investment advice that are both personal and practical.
That's right. The second quarter ended at the end of June, and so we've kind of looked through all the data and using, I say we, I mean our friend Mario over at East Bay, and we kind of read what he had and are going to just kind of have a conversation around what happened
the normal,
and what to look forward to, right?
Kind of check in on what happened last quarter and kind of where things stand with the economy. And not that we're going to predict where things are going, but we can certainly talk about what some of the possibilities are, right? Yeah.
Absolutely. So we always like to kind of start this segment with the positive signals and reasons for concern, right, Dave? So what's positive in as of the last quarter?
Over the last 12 months, we've seen inflation come down, which it needed to. And we're actually seeing the CPI come down as far as 3% as of June. So that's a positive. Basically, what the Fed has done to crank up interest rates and slow down the economy appears to be working, in that we're seeing inflation come back down.
Yeah, and not insignificant is the 3%. Obviously, the Fed's target where they would like it to be at is 2%, but continues to trend in the right direction. Had a pretty big drop this last month, so that's all good news. And, if you look globally at inflation, we being the United States, seems to be weathering the storm much better than some other places across the pond. So that bodes well for kind of how we've been able to attack this and the job that the Fed has done, along with the fact that, there was a lot of people that thought that the Fed's actions were going to push us into a quote unquote recession. And we've kind of almost gotten to that soft landing point. We're not quite there yet. Yeah. Obviously there's a lot that can change.
That's actually the second positive thing right now. The flip side of the coin is we've managed to slow the economy without crashing the economy so far. And the economic data continues to suggest that the U.S. economy is not currently in a recession. And if you think back to when we were doing this in January, an insane number of economists in there, like what's going to happen in 2023 pieces, that get pushed out in December and January every year, said, by now we'd be in a recession. It was just a question of how severe it was going to be.
Right. And that's one of those, and it's not that they're bad at prognosticating. But first off, nobody's good at it. Right. But also that's kind of the playbook before, right? The playbook is slow the economy down. Inflation, runaway inflation is more important to take care of than maybe being in a recession. And so that was kind of the playbook. So they were, kind of looking at past history of things like this. And that was kind of the expectation.
So far, it has not come to pass. Now we're going to get to reasons for concern here in a minute, and we'll revisit some of that. But the other thing that kind of goes hand in hand with that, though, on the positive signals, is the labor market remains strong, even while inflation has declined. And that boosts that optimism, and that maybe that the Fed's going to pull off a soft landing.
Yeah, the labor market is interesting because every time you see a labor market statistic lately that's positive, the market kind of reacts negatively because it's kind of one of those, it gives the Fed more room to continue
the fear is if
rates,
unemployment is too low, then the economy is going to stay hot. We're going to see more inflation and wages, and the Fed's going to have to keep increasing interest rates, right?
Right. And interestingly enough, I saw something the other day, I can't remember where it was, probably the Wall Street Journal, where the increase in wages was actually higher than inflation for the first time in a long time. So, and it seems to be that, and we have inflation still coming down, but yet we're seeing wage increases still. And it hasn't contributed to more inflation as of yet.
Right.
Obviously, that all can change.
Well,
but that's kind of what we're seeing as a positive that I think a lot of people
I'm certainly
didn't really
no
think could
macroeconomist,
happen
but
that
when
way.
I read those headlines, the first thing that came to my mind is that will hopefully make the average American consumer feel better about where we are, and we've talked before that
Right.
The economy really is dependent on our state of mind in a way. We can create a recession just by being afraid of a recession, but if you're actually
Right.
seeing more real dollars in your wallet at the end of the day, in terms of the price of things that you need going up slower than your latest wage increase, that's even if it's on a subliminal level, that's going to make people feel better. And kind of in my mind, at least, that was a good sign that maybe we will get out of this cycle without a severe recession, that people will continue to spend and do okay just because they feel better about how they're situated.
Yeah, and if you think about it, if you're still employed and you're getting raises and decent raises compared to inflation, you're probably feeling pretty good about yourself. You're probably feeling okay to go out and spend. And if your neighbors are in a similar spot, then that bodes pretty well for the
we should maybe say that a different way. Instead of feeling well, it's a relative thing, right? And consumer sentiment has been lousy for the last 12 months since inflation started to become an issue. The consumer sentiment numbers just have been lousy, and that was part of the fear, is that everybody was going to be like, right, oh gosh, I need to put my credit card away and stop spending money because things are going to get bad, and that would make things bad. That would start the cycle. So
right,
even if people don't feel good, if they feel a little bit better, that's good. That's good enough for me. So, I mean, again, I know nothing more than what I read. I don't pretend any expertise on the macroeconomy, but that to me seemed like a good thing.
Yeah, for sure. So this last point on our bullet list is an interesting one. It seems like this was a long time ago, but
it's funny how
really
these things seem silly in the rearview mirror, right? But last quarter, going into the quarter, big concern that the government was going to get into a standoff and not increase the debt ceiling, and that the U.S. would default on its treasury obligations. And it was similar, that kind of thing. I always harken back to Y2K at the beginning of my career, and how like if those things unfolded the way some people thought they might, like there was no end to the speculation of how bad things would get. And here we are. Oh yeah, it was just another, just another day in the life of American politics, right? Where the Democrats and Republicans both made demands and then backed down because neither one of them wants to be responsible for destroying our way of life. So yeah.
Right. Yeah. What do you
by
like to call that,
crisis.
Dave? Government
that's
by
democracy
crisis?
in a nutshell, and you can go back to the 1790s to see it. It's nothing we invented. It just seems new. So and they, in a way, they kicked the can down the road as usual. But we're definitely can put it on the back burner for 18 months or so, because they suspended it until 2025, right, where usually they set a dollar, like we're just raising the debt ceiling from X trillion to X trillion plus, a couple more trillion. And we never know when we're going to get there, right? Because it depends on how much tax revenues come in and how much the government decides to spend in the meantime. And it could be 6 months, it could be a year, it could be 3 years, could be 4. We never know. Instead, they just said, nope, for the next till January 1st of 2025, there is no debt ceiling. So maybe what that's done, is bought them some time to figure out something sustainable going forward. And I don't want to we just heard this morning that there may be some negotiations going on in Congress to just get rid of the concept of the debt ceiling. So,
it'll be interesting. It seems like every time we get into this, there's talk about, well, we should just get rid of it. But then, here we'll be in 2025 having the same conversation.
I'm not going to bet. Right. At least they're publicly talking about how silly it is. Because it was intended to stop the very thing that it's created. So anyway, moving on.
Right. So, with that little side note, what are we concerned about?
We're pretty proud of how inflation has come down here in the U.S., but Europe particularly, but the rest of the world has really been struggling with high inflation. And at some point, their central bankers are going to have to be making the same tough choices that our Fed has made, most likely. Since this was written, so, we're a couple weeks past the end of the quarter, England's numbers were a little bit better than expected here. Earlier this week? I think it was earlier this week. So, their headline inflation is still 7% or thereabouts. So, it's still more of an issue. And just anecdotally, we've got some Finnish friends, and they were talking about the price of food in Finland right now. Like they're just like on a week to week basis, afraid to go to the grocery store to see what's changed. So, in a way, the global economy is so intertwined, yet you still have all these little isolated economies making decisions on their own. Europe, the EU, the Eurozone would be akin to if Ohio and Michigan and Indiana all got to set their own interest rates on a central bank level, yet the U.S. dollar was separate from that. We know Ohio would screw it up, right? So it's kind of that's what you've got Germany and France and England. Well, not England anymore, Great Britain anymore, but Greece and Italy, and they're all trying to make independent decisions, but using one currency. So.
Yeah, it will be interesting to see how global inflation plays out. Obviously, there's a reason we have it listed on the reasons for concern section. Interesting to me enough. I mean, it's a no-win situation, right? I don't think anybody's running out and trying to take selfies with Jerome Powell, even though he's done a pretty marvelous job of sticking to his guns. Right?
Oh gosh,
it's like a thankless job at this point.
It's one of those jobs where sooner, like no Fed chairman ever goes down in history as like a great entity, because at some point they screw something up, then that's what they'll be remembered for. But so far he's talked the talk, and which, I say that it's not talk the talk and walk the walk, but the talk that they give has so much to do with it. How he's managed to craft the message in a way that helped what they were trying to do policy wise. And that's tough. That's tough. So far, I'm not ready to,
Yeah, and they're still talking about some potential interest rate increases, and it's not over yet, but so far so good as far as
and again,
getting
I'm no
things in the right direction.
Economist, but I want them to talk tough. I don't want them to be accommodating to the market. I want the markets to adapt to the conditions while the Fed says. I don't want them saying we're done when they don't know what the data is going to say. And.
Right. Well, and I think to your point too, Dave, we talk about inflation, but we've never, at least I know I personally have never experienced runaway inflation in terms of what that can do to an economy and what it can do to people.
Because
it's been such a long time.
I was 8 years old
really
the last time
seen anything like that.
Issue, and didn't know what a mortgage was, let alone how it worked. So
it's, and does way more
Right.
harm than slowing down the economy. But it's a really hard thing to
Right.
conceptualize because we've never really lived through it, right? Like the last time you said you were 8 years old. So I'm sure you had bigger concerns.
I don't even remember what they were.
The inflation numbers were, what was going on at the grocery store.
So, we've still got concerns about will this actually remain positive in terms of the overall economy, and are we on the edge of a recession? And so, one of the big ones that everybody has looked to, because it's been a pretty reliable indicator of a coming recession, is an inverted yield curve. And we have one.
Yep.
So, and that's where short-term interest rates are higher than long-term interest rates on Treasury. Usually we use the Treasury as the best measure of that. So what that means is the expectation is that the Fed is going to have to lower rates because the economy has slowed down too much and goes into recession. So if you're thinking about it in an investment standpoint, you would want to hold shorter term bonds before that happens. It gets a little mushy, but essentially it's a prediction that things are going to deteriorate, and you want to be more flexible. So that's still hanging over our head, that while everything else seems okay so far, unemployment numbers, layoffs, that kind of stuff all seems to say we're not in a recession, we still have that inverted yield curve that has been a predictor of recessions in the past fairly reliably. So now a yield curve gets fixed one of two ways, right? Either short-term, long-term rates go up, or long-term rates go down, short-term rates go down. So there's still the case that you can correct the yield curve back to a normal yield curve, either because the bond market realizes that the recession is not going to happen or not likely to happen, or because it does happen.
Right.
Either short-term rates come down or long-term rates go up, one or the other. So we will see. It'll probably be a little of both.
Yeah, just another reminder that, we're not out of the water yet, and obviously things can change and can change quickly. So, just because we have a lot of positive momentum of the quote unquote soft landing doesn't mean that something's not going to mess that up, and we would end up in a recessionary type territory, which is kind of what the yield curve is somewhat.
So, I guess the other thing that makes our list of reasons for concern right now is, while the stock market has been very positive this year, it's been driven by a handful of stocks. And so, for the year to date ending at the quarter, the S&P 500 was up just shy of 17%, 16.89% from January 1st to June 30th. And that's a great gain, but the average stock in the S&P 500 was treading water for the most part, while a handful of behemoth stocks were driving all of that gain. And if you had invested just in those stocks, you'd be up 40 or 50% if you were lucky enough to pick the right ones. So what does that mean? While if you're invested in an S&P 500 index fund, you've had a great year so far. That's great. But when a rally is narrow like that, when it's only a few companies doing really well and the rest are just kind of mushing along, it means the rally's kind of fragile, right? It means that maybe by and large, investors have bought into the idea that these few companies are going to do well, and they're driving those prices up, but the average isn't, so that, maybe the thoughts on the overall economy in terms of the market aren't as strong as that 16.89% return on the S&P 500 would indicate. So kind of like the yield curve, though, there's two ways that this gets corrected, right? Either those bets on those few big stocks were misplaced, and they come back down along with the everything else. And the 16.89% positive goes away, and what we would hope to see happen is for the rally to broaden, which means that more investors are looking at the economy and saying, well, rather than just bet on Apple and Google and these NVIDIA, the chip maker, has been driving this rally. Well, if the economy's if the market starts to feel the whole economy is doing better, you're going to see more names get added to that list, and the market continue to rise, but it be based on a broader swath of the market. So that's kind of what we're hoping to see here.
Mm-hmm. Yeah, it'll be interesting to kind of see what happens. A lot of that, like we said, is by those big companies, and a lot of that has been the what do they call it? The AI boost of all of a sudden AI became real popular, and all the companies that had a significant role in that, people felt like we're going to do very well, and therefore bought and drove that price up a little bit. So it'll be interesting to see how that all
whole
plays
AI
out in the short term.
Thing is fascinating, and maybe a podcast topic for a separate day. But everybody, the average American, I think, worries about it in terms of what it will mean for the economy. But history would show that kind of innovation is a net positive. So, we can look at that maybe.
Yeah, we'll have to
have to
go down that rabbit hole on another podcast for sure. But it is interesting.
So that's kind of where things sit, the positive and the reasons for concern for this quarter. One of the highlights, thinking about where we are right now, is looking back 12 months at where we were and the difference that's come to pass over the last 12 months. So June 30th, 2022, the index, the S&P 500 was down 19.96% from January 1st, 2022 to June 30th, 2022. The last 6 months this year, positive 16.89, almost reversed. Not quite, but almost. So that's like a night and day shift. The bond index, the first 6 months of 2022 was down 10.35%. I mean, that astounded me at the time. That was I couldn't wrap my head around the bond index being down 10% for 6 months. This last 6 months, a more bond-like gain of 2%, but positive nonetheless. Okay. And we've talked before too about how now those bonds are paying you higher interest too. So 2% on price gains, but also a higher income return. CPI 12 months ago was 9.1%. June 30th, CPI 4%. And now we're seeing 3% on that we've gotten since then. GDP growth for the trailing quarter was minus 0.6%. So it had started to contract. And for the last 6 months, the trailing quarter, positive 2.2%. That's a pretty robust growth for the economy in a quarter when everybody feels like everything stinks. The federal funds upper limit on the Fed funds rate was 1.75% on June 30th. It is now 5.25%. So that's a heck of a steep increase in interest rates over the last 12 months. And what was going on at that point, the Fed's latest rate decision on June 30th was to raise it 0.75%, which that's a big move in history terms, in terms of Fed moves. 0.75% in one meeting is big. This last one,
absolutely,
they paused and said in June, hey, maybe we need to wait and see where we're at now that we've made all these big moves. So you just look at the contrast between where we are now and where we were 12 months ago. And to me, I remember client conversations in June of last year where it was a lot of, do we need to get out of the markets? Is this going to keep getting worse? Well, again, just as it's, darkest, that if you had gotten out of the market in June of last year, you'd have missed a recovery that would have brought you back real close to even. So.
Yeah, it's funny that you should mention that, because another one of the interesting pieces in this, and we'll post this in the show notes, is letting the market headlines drive your decisions. And actually, in June of last year is when we were announced in a recession.
Yeah.
This was 2020, not last year. So this was June of 2020, which would have been 2 years ago. So if you look at the S&P 500 return, and when it comes into the news cycle and how that plays into your decisions.
This is a good one.
It's an interesting chart.
Definitely should talk about this for a minute. So this chart is looking at 2020. So the last time we had a recession was 2020 during the COVID crisis. Before the recession was announced, the market went from, the S&P was pushing close to 7,000 and dropped to about 4,500 in like a matter of about 4 weeks. Huge, steep drop. As the economy shut down, everybody panicked. The market from there in mid-March started to recover. And, still no word on whether we were in a recession or not. Everybody just kind of assumed we were. But the market started to bounce back. And the S&P was back to 6,500 in June, when we had the data to be able to say, yep, that was at that point we're in a recession. We're not sure we're out of it or not. Turned out we were already out of the recession, but the market had already made up all that ground while everybody was running around. We weren't running around. We were all sheltering in place, more or less. Right. But mentally running around like, how bad is this going to get? Where's the economy going to go? And if you had reacted to those headlines and gotten out of the market in, say, March, you were already dead in the water as far as making up ground. And by the time the data came in to say, hey, the recession was over, turns out it was short-lived, the market was about 500 points or so, 1,000 points higher than it had been when the whole thing started. So you can't use the headlines. If you use the headlines, you're already behind. You've missed it. You've missed the market move. This was a great example. We've always used kind of the same philosophy talk around early 2009, and in the middle of the financial crisis, that market bottomed out in March of 2009, and the data was still horrible going into 2010, halfway through 2010, before things started to look better. So,
it's just amazing. I mean, if you think about like what you would have had to do to time this right. I mean, essentially, I remember going to meetings in, probably February, where we were making jokes about not shaking hands and doing nuts and, hitting people's elbows because there was this, global pandemic that was coming, like the bird flu of before, and everybody was joking about it. At that point is when you wanted to be getting out, right? Like you'd have to be like the Chicken Little screaming about the sky falling down at that point. And then when things got to their absolute worst in March, when everybody was sitting at home, you would have had to say, hey, you know what? It's time to push them all back in.
The old cliche, be fearful when others are greedy and greedy when others are fearful. That serves you well. serves you much better than paying attention to the headlines. Well, all that said, is we don't know where things are headed. We never do, but we've kind of mapped out, what we're worried about and what we're looking at, but also, what are the bright spots. So, ask again in 3 months, right? All right.
Absolutely. All right, Dave. Well, this has been great. Appreciate it. If our listeners have any questions or any topics you'd like to hear on the podcast, we'd love to hear them. Shoot us an email at info@srbadvisors.com.
Yep. Thanks, Nick.
As always, it's been a pleasure, Dave.
This is a Zedia Media production.